if you look at last year, just looking at gold, I took out the figures. The stands for delivery last year were 491.2 tons. Basically, this year, that has accelerated. So far this year, 285.3 tons have been stood for delivery. Now, that is, if this continues over the rest of this year, what we're looking at is over 2,160 tons being stood for delivery in this year. So the pace of the stands for delivery has increased. Now, even though the bullion banks use every trick in the book not to let you have your gold, if you look at it from their point of view, they have a problem.
In times of economic uncertainty, investors often flock to safe haven assets, and gold has always been the ultimate fallback. But what happens when the demand for physical gold starts to outpace the market's ability to deliver it? We're not talking about short-term price swings or speculative bubbles. This is about the very foundation of trust in the gold market, and it's showing signs of strain. Recently, the London Bullion Market Association, LBMA, has experienced unprecedented delays in gold deliveries. Traditionally, withdrawing gold from the Bank of England's vaults took just 2 to 3 days. Now, these delays have stretched to 4 to 8 weeks, a significant deviation from the norm. Popular financial analyst, former stockbroker, and gold veteran Alasdair Macleod recently highlighted a critical trend that could signal deeper shifts in the global gold market. Last year alone, 4.912 tons of gold were stood for delivery. This year, that pace is accelerating. Currently, 2,160 tons are projected to be demanded by year's end, even with bullion banks doing everything they can to limit physical withdrawals. The pressure is mounting, and it's exposing cracks in a system that relies heavily on trust and liquidity. According to the World Gold Council, global gold demand in 2024 reached a record-breaking 4,974 tons, fueled by central banks stockpiling over 1,000 tons for the third year in a row and a 25% surge in investor interest. This combination of high demand and soaring prices is creating a perfect storm, one that could reshape strategies within the bullion market and influence global financial stability. In this video, we'll unpack what's really happening behind the scenes, why it matters now more than ever, and what it could mean for the future of gold as the world's ultimate safe haven asset. If you're an investor, market watcher, or just someone curious about how global finance really works behind the scenes, this is a conversation you can't afford to miss. So, before we dive in, make sure to like, subscribe, and hit the notification bell so you never miss an update on the markets that shape our world.
It is a fascinating situation. And I've listened to all the commentary, and yesterday I listened to a conversation between various members, sort of researchers and analysts and so on, of LBMA firms, and they were saying, well, there's plenty of gold. I mean, they were just sort of glossing over the thing, really. But
Really?
nobody mentioned one thing which I've been monitoring, and that is the stands to delivery. Basically, what a stand to delivery is basically where the credit market meets the road of reality, if you like. But because COMEX is run by banks, in effect, who deal in credit, not in physical, they basically, when you stand for delivery, you're not actually getting delivery. What you're getting is a commitment from the counterparty, if you like, on the transaction to deliver you gold at some stage. Now, what they do is they delay the delivery. There was a fascinating article by a guy who used to work for Sprott, and he wrote about trying to get delivery of silver out of COMEX. And basically, he said that a 5-day settlement took 9 months.
Wow.
9 months. and that was with Sprott badgering as hard as they could, trying to find out where is it, the whole thing. Eventually, it was delivered in 9 months. Now, the reason this is important is because stands to delivery have been increasing quite substantially. I mean, if you look at last year, just looking at gold, I took out the figures. The stands for delivery last year were 491.2 tons. Now, basically, this year, that has accelerated. So far this year, now that is, if this continues over the rest of this year, what we're looking at is over 2,160 tons being stood for delivery in this year. So the pace of the stands for delivery has increased. Now, even though the bullion banks use every trick in the book not to let you have your gold, if you look at it from their point of view, they have a problem. They can see that pressure is going to mount on them to deliver. Therefore, they've got to have the stock. And that's basically, I think, what has led to it. We can feed in another thing into this, and that is that anyone who looks at the chart of gold would come to the conclusion that it's going higher. Now, that includes bullion bank traders. I mean, they're not idiots.
No.
So they're in a position where they are short on COMEX. Now, we don't know what their position is in London because, I mean, traditionally, the idea was you'd be long in London and you cover in COMEX. I don't actually buy that story. I think it's a lot more complex than that. But if we look at COMEX, you can see that the short position is getting increasingly painful.
Mm.
And if you add into that the fact that you've got all these stands for delivery, and I can tell you that the stands for delivery from 21, 22, 23, and 24, almost 2,000 tons. Now, some of that presumably has been delivered, but you can see the pressure that's coming on the establishment, if I can call it that, in COMEX. This is why COMEX has had a sort of bear squeeze, because at the same time, if you look at outstanding contracts on COMEX, recently they've fallen by 75,000 contracts. That's the open interest. Now, while it's been falling by 75,000 contracts, the price has been rising. So what's that? It's a bear squeeze, and it's a bear squeeze on the shorts. It's as simple as that. So that is basically where the problem is. Now, look at it from the point of view of the buyers. We don't know who they are, but it's reasonable to suggest that the people standing for delivery aren't that close to COMEX, if you like, as an institution. They're probably dealing via Globex, which is the global dealings which occur, when New York's shut and all the rest of it. So, if, let us say, you are the sovereign wealth fund, central banks, a very rich Asian family, and you stood for delivery, you're now looking at this new world with President Trump. And there are two things here which will worry you. The first is that Scott Bessent is keen to set up a sovereign wealth fund, of which the Treasury's gold will be a central part. Now, what Scott Bessent didn't know, but presumably he's now been put straight, so we'll probably go quiet on this one, is that most of the gold just ain't there. It's gone. It was long gone. So the idea that he could put 8,132 tons of US Treasury gold into this new sovereign wealth fund, for whatever purpose, I mean, I don't know where he's coming from on this, is a complete nonsense because it's not there.
The gold market is currently riding a wave of volatility, with several underlying forces pushing it to the edge. According to Alasdair Macleod, one of the biggest pressures right now comes from the substantial short positions held by bullion banks on the COMEX. In simple terms, these banks have bet that gold prices would fall, but the opposite is happening. As gold prices continue their upward climb, these short positions are becoming financial quicksand, forcing the banks into what's known as a bear squeeze. Here's how that plays out. Normally, when traders short gold, they're counting on prices to drop so they can buy back at a lower rate and pocket the difference. But when the market flips and prices rise, short sellers scramble to buy back contracts to cut their losses. This panic buying pushes prices even higher, a classic bear squeeze. Evidence of this is crystal clear. COMEX's open interest, The total number of outstanding futures contracts has dropped by 75,000 contracts recently. Yet, gold prices have kept rising. This inverse movement is a major red flag that short sellers are being squeezed out, covering positions at hefty losses. But that's just one side of the storm. The other, and arguably more alarming factor, is the massive surge in demand for physical gold deliveries. Over the last 4 years, nearly 2,000 tons of gold have been stood for delivery on COMEX. To put that into perspective, it's not just small-time investors demanding physical gold. This scale suggests major players like sovereign wealth funds, central banks, and ultra-wealthy investors are actively securing tangible gold. Let's get back to Macleod's video.
There is the other aspect on this, and that is that Trump has turned around and said several times he wants to devalue the dollar. So what does that do to the gold price? Obviously, the gold price goes up. If I'm going to get the benefit of the devaluation of the dollar, then I don't actually want to have it sitting in a COMEX vault, allegedly under the aegis of one of the big bullion banks.
Yeah.
So you can see that even though the bullion banks have put an awful lot of obstacles in the way of people actually wanting to take physical delivery as opposed to just this stand for delivery myth, you can see that there is huge pressure now to actually deliver physical bullion and deliver it outside America. So I think the bullion banks are very aware of these pressures. They don't necessarily understand the thinking of these pesky foreigners, but the one thing they do know is they got a problem. And so that, I think, is why they drove up futures premiums over spot. It was part of that bear squeeze, trying to close their liabilities. And as I say, the open interest fell by something like 75,000 contracts. Obviously, when you get a big premium like that, then liquidity gets sucked out from the rest of the world.
Yeah.
So if you look at London, we know quite a lot of this liquidity has come out of the LBMA vaults. It's also come out of the Bank of England's vaults, where there is a queue into the end of March, apparently, because they're going to deliver something like 5 tons a day. So this is actually quite a serious problem for the bank, and it makes you wonder how much of this is gold which has been leased to try and dampen down, if you like, the market. So I think the whole system is in panic, is really what it boils down to. And I don't think we've got the end of this story. The premiums on COMEX have gone down. They're back to normal, sort of lease rates or implied lease rates of under 1%. The lack of liquidity elsewhere is creating further problems in the market. And so when I listen to the analysts working for LBMA banks, Brian, there is another aspect to this. At the moment, there is really very little interest in gold amongst the retail market in the West.
So what do you put that down to? What do you put that down to?
Basically, I think people have been invested in tech stocks, equities, all in that bubble.
Yeah.
At some stage, that bubble's going to go pop. Then they must be already noticing that gold's going up, but so far they're ignoring it. They're sort of thinking, well, and I think that they're hardly at the point where they're sort of thinking, I better find out a bit more about this because this could be an opportunity, or they haven't really latched onto it yet. So what we're talking about is a very big market. So you've got liquidity, if you like, for the sort of people we deal with, who might put in $100,000 or that sort of size. But I mean, if you're wanting a ton of gold, it's not quite so easy to get hold of it. If you see what I mean. So you've got these two levels.
Yeah.
And the other thing with talking to coin dealers in the UK, they tell me that there's yeah, the buying interest is not all that great. They're seeing stuff coming in, um, basically because people can't afford to put food on the table. So they're
The gold market is teetering on the edge of a storm, and the warning signs are impossible to ignore. With President Trump openly advocating for a devaluation of the US dollar, the ripple effects are hitting the gold market hard and fast. It's simple economics. When the dollar weakens, gold shines brighter. Investors know this. Bullion banks know this. And now, they're stuck between a rock and a hard place. As gold prices climb, the cost of maintaining massive short positions on COMEX becomes increasingly painful, intensifying the already aggressive bear squeeze that is currently unfolding. But the problem runs deeper than just rising prices. Investors aren't just betting on gold. They want the real thing. And that's where the system starts to crack. Despite the COMEX and bullion banks' best efforts to make physical delivery difficult, demand has skyrocketed. Wealthy investors, sovereign wealth funds, and central banks are bypassing the paper game, demanding tangible gold they can hold, often choosing to have it delivered outside the US. This surge in demand is bleeding liquidity from major vaults like the LBMA and the Bank of England. There's even a queue running into March, a massive red flag that the physical gold market is straining under the pressure. This isn't just a market hiccup, it's a systemic stress test, and the cracks are widening. The bullion banks are scrambling, hiking futures premiums to curb the squeeze, but in doing so, they're sucking liquidity from global markets, worsening the very problem they're trying to contain. Investors are now forced to ask, is there really enough gold backing all these paper promises? If not, the consequences could be explosive. So, where does this leave us? In a market where trust is the ultimate currency, the foundation seems shakier than ever. Will the system hold, or are we watching the early tremors of a much bigger collapse? One thing's for sure, this story is far from over, and as the gold market tightens, the stakes have never been higher. What do you think is next for gold? If you found this deep dive insightful, don't forget to like, subscribe, and drop your thoughts in the comments. Thanks for watching, and we hope to see you in the next one.